Let me start with a simple question. If you had switched off the news in Jan and only looked at the real economy, would you feel worried or confident? Here's the thing. Jan was not a dramatic month for markets. It was a month of clarity and reflection. Growth stayed intact, but uncertainty became louder. And for long-term investors like you, learning to separate noise from real signals matters far more than reacting to every headline. Hi, I'm Saurabh Shrivastava from the research team at MFA, and you are watching The Story of Our Markets. Let me walk you through what truly mattered in Jan and what we are watching next. Globally, growth is still holding up, but uncertainty has gone up. In the US, the Federal Reserve did not cut interest rates this month. They paused after cutting rates 3 times in late 2025. What this really means is simple. The US Central Bank is saying, let us wait and see how the economy behaves. So markets are now expecting the next round of rate cuts only from middle of this year. Because of that, US bond yields moved slightly higher and equity markets were mixed. Now, on top of this, geopolitics is back in focus. The Russia-Ukraine situation has not really improved. Tensions between the US and Iran remain. And there were fresh trade announcements by the US, including higher tariffs on certain imports. Whenever trade barriers rise, markets become nervous. Not because business stops overnight, but because costs go up and visibility goes down. Gold clearly reflected this nervousness. Gold moved sharply higher during the month as investors looked for safety. Oil, on the other hand, stayed broadly stable. Bitcoin was volatile but ended the month more or less where it started. So globally, the story was simple. The economy is okay, but confidence is fragile. Now let me come to India. And here, the story is far more encouraging. Look at the real economy numbers. Manufacturing activity in India improved. Services activity improved even more. Industrial production grew at the fastest pace in more than 2 years. In simple words, factories are producing more and services companies are seeing higher demand. Yes, GST collections were slightly lower on a year-on-year basis, but 1 month doesn't make a trend. What matters more is the broader momentum, and that momentum remains healthy. Now, one very big development during this month. India signed a long pending trade agreement with the European Union. This deal has been in discussion for almost 2 decades. Alongside that, there were also positive signals that a trade agreement between India and the US is moving closer. Trade agreements may not create headlines every day, but they quietly improve exports, investments, and long-term growth. Now let me briefly touch upon the Union budget. I'll keep this very simple. The most important message from this budget is continuity. The government has clearly said we'll continue to spend aggressively on infrastructure. Capital expenditure has been increased again. This includes roads, railways, logistics, manufacturing, and new industrial corridors. Why is this important for you as an investor? Because government infrastructure spending has a very powerful ripple effect. 1 rupee spent by the government usually creates 2 to 3 rupees of economic activity in the system. The budget has also stayed disciplined on fiscal deficit. There were no major negative surprises on capital gain taxes. And some small but positive reforms were announced in foreign investment limits and overseas remittance rules. So, from a market perspective, this was a supportive and sensible budget. Now let me come to the most important part. What are the risks we are watching? The biggest risk right now is global. If trade tensions rise further or geopolitical situations worsen, the US dollar can strengthen. When that happens, money tends to temporarily move away from emerging markets like India. This does not change India's long-term story, but it can create short-term market volatility. Another risk is unexpected strength in US data, which may delay rate cuts. Again, this affects sentiments, not India's fundamentals. Now finally, our outlook. Here is our clear and honest view. India remains one of the strongest large economies in the world today. Consumption is holding up, investment is improving, government spending remains supportive. Corporate earnings are likely to improve meaningfully in the second half of the financial year, helped by a lower base and possible interest rate easing. If progress continues on India-US trade discussions, it can become a strong trigger for foreign investor flows back into Indian markets. Periods like this, where markets consolidate and sentiments is uncertain, are exactly the periods where long-term portfolios are built. Our approach remains unchanged. Stay disciplined, stay diversified, stay aligned to your goals. And yes, any short-term market dips should be treated as opportunities to accumulate gradually, not as reasons to panic. As always, we continue to actively monitor risks and rebalance portfolios wherever required, based on your personal goals and cash flow needs. Thank you once again for your trust. I'll see you next month with another simple and honest market update.